Hi friends, no matter when you are watching this video, this is an extremely important video because in this video I'm going to discuss with you why the market in Japan has crashed like anything. Number two, why the US market has also at the same time crashed like anything and its ripple impact on Indian stock market. And number three, what does this actually mean for Indian stock market and more importantly your portfolio, what should you do? It's going to be an extremely important video with lot of macroeconomic data analysis. And if you don't know me, my name is Rahul Jain and I'm a full-time investor. With that, let's get this video started. So let's start with why Japan's market has crashed like anything. If you see my screen, you will see that today at the time of recording this video, Japan's Nikkei 225 has fallen by around 12.40%. Last 5 days, it is down by almost around 18%. And in the last 1 month, it is down by around 23%. 23% fall in any stock market is considered very big fall within few days. So what is going on here is what we need to understand. For this, very important concept that you need to learn today is a concept of carry trade. Allow me 2 minutes of time to explain this to you. So imagine a country A that is offering you loan at let's say 2% interest rate. And since 2% interest rate is a very cheap loan interest rate, as an investor, what will you do? You will say that Rahul, I am happy to take loan from country A. And let's say that you take 10 lakh rupees of loan from country A at 2% interest rate. Now what you can do with this 10 lakh rupees is that you can go and invest in country B where you expect to generate returns of let's say 8% and 10%. So that what you've done here is that you've borrowed from country A at a 2% interest rate and you have invested in country B and generated returns of let's say 10%. So in this entire trade, you have not put your own capital. What you've done is you've taken a risk here, but what you've done essentially is that you've done an arbitrage where you've taken money at 2% interest rate and you've earned 10% from country B, giving you 8% of net profit. Now this concept is called carry trade, and essentially what you've done is you've carried over from one country to another and hence have made some handsome money. Now replace this country A by Japan and country B by US, and this is exactly what investors have done. They have borrowed from Japan and have put the money into US in the last 8 to 10 years, earning a lot of money, which is now coming back and biting them back. Let me explain to you how that is there. Now for this concept of carry trade to work, the country A and country B needs to fulfill two key criteria. Criteria number one is that in country A, the interest rate, the borrowing rates needs to be really low. And secondly, country A's currency need to be really weak as compared to country B. So these two criteria, if they are met, then this carry trade concept really works beautifully for country A and B's combination. Let me now prove this with some data for how it has worked out for Japan and US for the last 8 to 10 years. Have a look at my screen and you will see this is the Bank of Japan's interest rate, the rate at which Bank of Japan lend money to banks within the Japan, right? This is also called US Fed rate in the case of US. In our case, it is called the repo rate. Now here, what you see interestingly is that Bank of Japan's interest rate back in 2008 used to be only 0.50%, right? And India right now we have repo rate at around 6.5%, and in US we have at around 5.25 to 5.50%, where in Japan we are only talking about interest rate at 0.5%, very low interest rates. And in fact, if you see for a very long period from 2008 onwards, it remained very low at 0.10%. More interestingly, if you see this time frame here from 2016 onwards, this interest rate was in negatives, meaning that if a person need to deposit money in bank will not give them any interest rate because it's a negative interest rate. The person will have to give money to bank to keep that money safely. You won't see this sort of phenomena anywhere in the world except what has been happening in Japan. So the key question is, why was this happening in Japan? And for this, have a look at the second chart here, which is the inflation rate in Japan. And what you will very quickly note is that after 2002 or 2004, the inflation in Japan has been really low. In fact, there have been times where there have been deflation, where the product prices are not going up. In fact, they're coming down. Why? Because people are not spending their money, and therefore what happens is when your inflation rate is very low, people are not spending money in your economy. What the interest rates will be? They will be really lower, because what government wants it, people to borrow money so that they can go ahead and spend the money, so that the economic cycle goes up. But that was not happening in Japan. That's why Japan kept their interest rate very low. In fact, in negatives for a number of years, and that's why Japan became the perfect candidate for country A, where the interest rate is very, very low. Now comes the weaker currency criteria number 2, and if I show you some data here, you will see that in the last 5 years how Japanese yen has been depreciating against US dollars. If you see, it has come down very, very massively. Now there could be a multiple reasons why the currency has weakened in the last 5 years. Again, if I go into those details, it will become a video dedicated only why the currency has fallen. So let's just keep that to one side and just remember that two criteria here Japanese have met is number 1, very low interest rate, and number 2, their currency has weakened. Now due to this, what has happened is many investors within Japan, what they have done is they have borrowed a lot of money from Japan and have invested this money in US. Why in US? Because A, US is the number 1 economy, and US economy has been very, very strong in the last 20 years. So this phenomena has been going on for a number of years. It's not something that has just happened overnight. It has been happening for a number of years. Now you must be wondering that, Rahul, you've explained so much details about it, but we still don't understand why the stock market in Japan has fallen. This is mainly because just few days ago, what Japan did was that they have now raised their interest rate by 0.15%. If you look at the same chart again, you will very quickly notice that just few days back, what they've done is they've moved from 0.14% to 0.25%. And when the Japan has done this, what this is likely to do is it has created a fear that if in Japan interest rate goes up, the entire logic of borrowing from Japan will go for a toss. And now what people are trying to do is they're trying to sell the stocks in US or equities or the bonds in US, and they are trying to pull the money out of US market because they have to potentially return it back to Japanese economy. And this is the first sign of reversal of this carry trade happening. That's why there is a fear going on. That's why Japan stock market came down. That's why US market also came down, which I'll speak about in a minute in terms of why US market is also falling down, because there are some US economy related issues as well that are going on. So far, if you're liking this video, hit the like button and let me know in the comments. Simple thank you. It will motivate me to come up with such content for you at zero cost. Also, you can consider subscribing to my YouTube member community. I post updates almost on daily basis on my YouTube member community as well. With that, let's move to the point number 2, which is why the US market is falling now. And if you look at the Nasdaq, you will see it is down by around 2.5% in last one day. And if I look at the last 1 month, it is down by around 9%. So if I look at the YTD here data, you will see that it was all-time high at around 18,600 level, and now it has come down to 16,700 level. Almost 2,000 point crash is what we can see here. 10 to 11% it is down within a month of time. Also, you might have heard in the news that legendary Warren Buffett has been sitting on cash now, 277 billion US dollars. He's been selling Apple stake and so on and so forth. And the key reason that the US markets are falling is mainly because there is a fear of US going into recession. And there are two important metrics that are indicating that there is going to be a slowdown in US. So let me quickly present you that data. So just last Friday, 2nd of August, it was published on US official website that their unemployment rate has gone up, which has gone to 4.3% in the month of July. So it has gone up by 0.2% and it is now at 4.3% in the month of July. And the number of people that have become unemployed has gone up by around 352,000 people. So total 7.2 million people in US are unemployed as of month of July 2024. It used to be at around 5.9 million last year. So if you compare this with the last year, 5.9 million people were unemployed in July month. Now in this year, in July 2024, 7.2 million people are unemployed in US. And that is an indication for people that if the economy is doing well or not, because if the people are unemployed, then it means that there is a problem in terms of people finding jobs. The second key measure of the economic activities in any country is their manufacturing activities, which is in the case of US is measured by an index called Purchasing Managers Index or PMI. Now, if you see the data in the month of July, this index has fallen to 46.80, simply meaning that the manufacturing activities in US has slowed down in the month of July. So if the manufacturing activities are slowing down and at the same time people don't have jobs, then what is likely to happen? People will start to get fearful about upcoming recession. Thirdly, if we see US Fed has not yet done the rate cuts. We have been waiting for a long time now, but still they have not done any rate cuts, and it is likely to happen in the month of September. And many investors feel that it is slightly too late. They should have cut the rates few months ago. But again, this is one sentimental factor here as well. Fourth point to note is what is happening between Iran and Israel. Because of the war situation that has been built there, US will not be left out of this war if these two countries go on to war. I don't know when you're watching this video, but by then things might be very, very clear. But the simple point is that because of these factors, US market is down. An important takeaway for you here is that nobody can predict the stock market movement, because as you can see, this data about unemployment rate was only published a couple of days back. So how can people predict about whether the stock market will fall or not? Because it is the data point that is driving the fear in the market, and investors are selling off their equities. Let's move to point number 3, which is why Indian markets are falling and what is the impact on your portfolio. What should you really do in this particular situation? So point number 1 here is that Japan's problem is Japan's problem, not India's problem. Secondly, US's problem is US's problem, not our problem. Indian equities are nothing to do with these two, but still our stock market has fallen, mainly because we still have fairly large percentage of our equities held by FPIs, foreign portfolio investors. If I show you some data, you will see that as of June 2024, 17.38%, the blue line that you see here, 17.38% of our equities are held by foreign portfolio investors. Although if you see the DIIs, which are, for example, mutual funds, insurance companies, pension funds, which are based in India, their ownership of Indian equities have been going up and it is gone to 16.23%. So the difference between FPI holding and the DI holding is very, very low now. It has come down to almost last, I don't know, 10 to 15 years of low gap between FII and DIs, but still we have a lot of FPIs. That's why foreign investors are selling Indian equities as well out of the fear, because they are going to go and invest in safe havens, for example US bonds or gold as well, because you might have seen in the last couple of days the gold prices have started to go back up. But to be honest, whenever the markets have fallen in the last 6 months to 1 year, what I have noticed is that very quickly they have recovered, because DIIs start to buy back in Indian equities, and that's what the trend has been in the last 6 months to 1 year. The second key point we need to think about Indian market is from a valuation perspective. And if you see here Nifty PE ratio chart, you will very quickly note that right now Nifty PE is at around 23. And in my view, it's not overvalued, it's not undervalued, it's right at the sweet spot, because overvaluation will be somewhere when Nifty PE is trading at around 38, 40. You see these 38, 40, 40 here back in January, February, March 2021, while Nifty was trading at around 19, 20 in the month of June, July 2022. This is where I call personally Nifty undervalued. Right now, in my view, at 23, it is a fairly valued game. I don't think we are highly overvalued right now. And to be honest, if I see Nifty has fallen down by 2.68% today, but if you look at the picture in the last 1 year, Nifty gained almost 22%. So we have seen a massive rally in the last 1 year, and if the market fell by 2%, I don't think it's a much fall, to be honest. There might be more falls, there might be some sideways movement now going forward because of the problem that is there in the US, the problem that is there in the Japan. But overall, in my view, Indian markets are not highly overvalued that we should worry about. Now comes the most critical point. What should you do in terms of your own portfolios? So quick few points that I want to make. Point number 1 is that I'm not going to speculate and tell you whether the market is going to continue to fall, whether it will rise or not. There are people out there who are creating a lot of YouTube videos giving you Nifty support levels and all that. I'm not a technical trader, so I don't even look at those charts in terms of where is the next level support and all that. For me, the critical point here is that I am not selling even a single equity right now from my portfolio, not even index fund, not even ETFs. That game is very dangerous, where you try to sell and try to buy and all that. We are not trying to time it at all. Point number 2 is, if you're a SIP investor, in my view, you should continue to do your SIPs. The entire purpose of doing SIP is that no matter what happens in the market, you continue to remain invested. You don't become fearful, don't get panic, and don't sell your portfolio, in my view. In fact, continue to do your SIP. Point number 3 is, I will continue to buy in this market. In fact, I wrote a detailed note this morning when the market was falling to my YouTube member community, and I explained to my YouTube members that this is the time where I am buying personally. I am taking some bets into some sensible long-term assets that I have built for myself. Again, if I name them, they might become recommendations, and my intent is not that I share you the names of the stocks, but in my view, I am going to continue to buy. And in fact, I've divided my cash into 4 to 5 chunks. Today itself, I deposited 1 chunk there because I don't know when the market will bottom out. In my view, we need to always keep some cash positions. That's what even mutual fund managers do. That's what the big investors do. So again, there is no time to panic here. Just keep calm. If you're really getting jittery about your portfolio, go away, take some break, go for holiday. Don't track the market at all. Stop reading some bad news because these are very dangerous for you. In my view, if you're a long-term investor, there is nothing to worry about. In the next 2 to 3 years, let me tell you that you are going to forget about what happened on 5th of August completely, because in the long run, market will continue to rise. Indian economy is strong. We have a lot of good companies that are continuing to earn more and more money quarter on quarter, year on year. We shouldn't worry about, as long as you know which stocks to pick, which index funds to buy, which ETFs to invest. And if you do not know any of that, just continue with your simple SIPs. You're going to build wealth for yourself if you remain invested in the long term. I hope you enjoyed this video. If you did, hit the like button. Let me know in the comments a simple thank you. I'll see you in my next video. Until then, keep rocking.